Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in and listening each and every week. We really appreciate it. By the way, we're on the Big 8 podcasts, and there's a number of them, Google and Apple and iHeartRadio and Spreaker. And Daryl, you got the rest of the list there?
I sure do. You did mention Spotify, Stitcher, iHeartMedia, Radio.com, and YouTube.
Yeah, all these places that you can listen to the show, they're great because you can go there, you can listen. You can join our club of people who get alerts each and every week as to what we're doing and how we're doing it. That'd be awesome, too. We're also on YouTube. We shoot this video. Obviously, if you're watching us, you know that. But if you're listening to us on the radio, go to YouTube, Jeff Barton, the Mortgage Voice, and you can see us there each and every week. You can see the guest. You can see myself, and a way to contact the guest if you like what you hear. If you do like what you hear, hey, sign up, join in, be part of what we do each and every week. We are trying to get information to you. It is not easy because the mortgage market, like a lot of other things, changes on a daily basis. It's not like you're buying, items from the grocery store. Price goes up, price goes down. But in our business, the products themselves change. The prices are obviously going to be dependent upon you mostly. If you have good credit, you have a job that you can prove you have a job. And in proving you have a job, you're going to have to prove it 4 times during the process, just to let you know. So if there's an issue that you keep going back to your broker, your banker, your whoever else is helping you get a loan, and you say, hey, we just did this. Well, that's true. We're in the COVID world. And so proving that you have a job and you have a job all the way through the funding process is part of the deal. So if you understand that, maybe you won't get so upset when more information is required, or another person at the company that you work for is required, or whatever else they're looking for to prove that you're still working, that's required. Again, thank you very much. We are on a number of different radio stations. We have a new Albuquerque affiliate, a new Las Vegas affiliate, if you want to put it that way. I mean, we've been with both of these stations 4 to 5, 6, 7 months, maybe right at the start of the year. Our standard and favorite stations out at KCAA, KMET in the Inland Empire. I want to say hi to those people. They're the backbone of what we do each and every week, and up at K-Tahoe in the Tahoe area as well. Thank you very much again for listening to the show each and every week. Information about what's going on. We also do this LinkedIn and Facebook show each and every day. It's 3, 4, 5 minutes. It's a quicker version of what we do here. And I just got through trying to cram in an hour's worth of radio material into 3 minutes for LinkedIn and for Facebook. Needless to say, I was just motor mouthing it. But if you do see me there, that's what this is, in a slower, more easily digestible format. However, if you want a quick format, go to LinkedIn, Jeff Barton. You can see me there. Or Malibu Funding, and let's see. Yeah, Facebook is the Malibu Funding. LinkedIn is Jeff Barton, and you can see this as well as many other different types of things on my YouTube. Okay, let's get right to it. What's happening? Well, we know that what happened at the end of last week was the extra $600 a week was, being canceled because they can't seem to come to an agreement in Congress to be able to fund, and that would affect millions of people on unemployment. Which, what does that mean? A great many of those people on unemployment are renters. So what's happening? Well, we've heard and are beginning to hear even more the desperate attempts of renters to stay in the property that they are renting, but not paying rent, and the desperate attempt of the landlord to get them out so that they can get somebody in there to pay the rent. There is no bad guy in this scenario. There's only people struggling to pay their bills, whether it's the person who owns the property or the person who lives in the property. The responsibility of this lies with the legislatures, legislators, and they can't seem to get it together. So my plea to them is, please get it together. These people need help. No fault of their own. It's not like they're deadbeats, and the characterization that somehow we need to lower the amount of money to incentivize people to go back to work in a situation where death awaits a certain percentage of these people who go back to work is a choice that you can't have people make. You have a family, a mother, a father, children, every one of these things affected by the decisions that they have to make based on whether they got to go back to work or not because of the rent situation. President Trump tried to jump in with some executive orders. Everybody's yelling at him because he can't do that. The Democrats are at one number, the Republicans are another number. Come on, people. There are lives at stake here. Let's just get it together and get it done, okay? I don't really care about the politics. I just know that, like I say, through no fault of anybody's, this is happening. And as an example of what I'm talking about, the number of delinquencies, that is the number of people who are not paying their mortgage. We've switched from renters, now we're talking about mortgages. So before the COVID, before March 16th, we were at a 50-year low. Think about that, 50 years, and we had never seen delinquencies so low in the mortgage industry. 1 month later, in May, we were at an 80-year high. So we went from a 50-year low to an 80-year high in 1 month. Nobody was a slacker. Nobody was defrauding anybody. The federal government said, stay home, close businesses. As a result, 40 million people got laid off. Now, we have not recovered enough from that. Excuse me on that silliness there. So what do we do about it, and how do we fix the problem? Well, as I laid out, Congress has got to get their act together and make it happen. Hopefully they will, but this lackluster, slow boat is really, it's not a good thing. It's not a good thing for people who have families, for people who are starving, and for renters who are going to get kicked out because they can't pay, and for landlords who are going to also go into a foreclosure because they can't pay the mortgage. It's just a terrible, horrible situation, and we got to remedy it. Let's talk a little bit about the bonds. Okay, we have been riding, and I'm going to steal a couple headlines here, riding a great wave of bonds, i.e. the bonds have been in huge demand. These are treasury bonds. These are mortgage-backed securities that are being sold by obviously Fannie and Freddie and the Treasury. What does this mean? People around the world like to come to the U.S. for safe haven of their money, which means that the demand for these things are really high. When that happens, the mortgage rates fall, and that's what's been happening. However, in the last week or 10 days, and especially today, what we have seen is the demand has softened, i.e. there isn't as much demand, i.e. the rates are going to go up, your mortgage rates. So what are they? 2.85% for a 30-year fixed, 2.38% for a 15-year. The FHA is down. Those two last on conventional are up. FHA is down 2.25. That's a little flat, and the jumbos are actually down. So we could see this as a trend. And one of the things that they watch, and you should watch, go to Mortgage News Daily. You can read all this stuff every day too. I'm bringing it to you because I can read and get it to you quickly on this very easy format for you. Turn on your radio. But if you want to get in depth in it, go to Mortgage News Daily. That's where I go. It's all over the internet anyway. And try to prognosticate any of this stuff is not easy, simple, or straightforward. But that's where we are in rates. And in so doing, in talking about bonds, in talking about rates, understand that they are linked, right? If bonds have a weak demand, people don't want to buy them, that means your interest rate on your mortgages is going to go up. But let's be honest, the mortgage rates have been never so low. So if you're thinking about doing it, don't wait for it to go down anymore. This is the time, because you just don't know, as I started at the top, what's going to happen. It's volatile. That's why we do this on a daily, and the weekly radio show brings it to you every week. Thanks very much. We'll be right back. I'm Jeff Barton for The Mortgage Voice.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks for tuning in. We're on a Big 8 number of podcasts. Daryl, do you have that list for us?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, radio.com, and YouTube.
So if you go to any of those and you type in Jeff Barton, the Mortgage Voice, you'll get this as well as a lot of archive shows. And we have a ton of information each and every week. We bring guests to you to give you some different perspective. Usually what I try to do is bring some guests who are lenders, and we'll have done that and will be doing that now and in the future to give you an idea of what programs are available for borrowing money. And then we try to bring on maybe a loan officer or two or somebody else in the industry who can give you an example of how it works with you, with your lender, with a certain professionals that we do bring on the show. The reason is that it's like a lot of things. There's a team effort every time, and I hate that word. I hate using it. I've been on many, many teams in my life, and it has nothing to do with business teams. Business teams means that it's a cute marketing tool. You see it in real estate a lot with the XYZ team or the first blah, blah, blah team. Yeah, maybe it's a team approach. Maybe it isn't a team approach. But the point is that when you are with a lender or with your mortgage broker or banker and you're trying to get a loan for a purchase, let's say for a real estate purchase, yeah, you got to deal with your real estate agent, you have to deal with the seller or the buyer, and you have to deal with your mortgage broker or their mortgage broker. So all of these people consist your team. You've got escrow, you've got title, you've got home inspections. Yeah, you have a lot of people to, deal with. Usually your real estate agent is the person that does that kind of coordination, usually quarterbacks the whole thing. Again, another athletic reference, sorry about that. And then to pull it all together at the end to close, everybody's always happy because it's incredibly stressful. And those people who help you through that process are on to the next thing. And the seasoned veterans know how to be able to treat you and to be able to help you through the process without getting wrapped up in the emotion of it. Because nobody wins when that happens. And I've been involved with many, many transactions over the years that have gone that way, but also way many more that have not. And those are the ones that are easier for you, they're easier for us as professionals. One of the things about real estate that I wanted to talk to is talk to you about, the real estate market is an interesting thing right now. We've been dealing with low inventory for 6-7 months. Usually that means prices rise, and it's no different now. The difference between a normal market when inventory is low and now is that this has been thrust upon us because of COVID, because of the coronavirus, because people don't want other people in their house. A large majority of people in the United States, regardless of what you see on TV, are frightened. They don't want to get this, or they're mad because they think it's all a joke, right? In any case, even people who are mad and think it's all a joke, they don't want strangers in their house, and for many reasons. For people who happen to listen to the federal government and their restrictions, if it's the CDC or whether it's the World Health Organization or whether it's just your local county health official, they're all telling you, look, you got to stay away from people, you got to wear masks, and you got to make sure that you're using the type of products to clean that kills the virus. Leave the windows open, all this aeration. So what does that mean? It means that there's less property today on the market than there has been in a long, long time. Let me get you some facts here so that I know what I'm talking about. Let's see. Okay, this is through 8/2, through August 2nd. Now we're a bit away from that, but let's just look at this as an example. We are looking at New listings, that's a property that has just come on the market within the past week. New listings are down 2.7% from last year. And last year, they were down overall. Also, all active listings, like you might have a property, I'm selling a property right now. It's been on the market for a week. But there are many properties in this particular class and price range which have been on the market for 2 weeks, 3 weeks, 5 weeks, 7 weeks, 8 weeks. And those are active listings. So all active listings in the MLS across the country, 28% down. They're down 28% from where they were a year ago, when it was already a tight market for properties in terms of availability of sale. This means that prices are up. How much are they up? They're up 9% year over year. 9%. Now, we in earlier shows, a month ago even, were saying, based on what we had from CoreLogic, that prices were going to be down by May of the following year, 2021, by 5 to 6%. They were revised last week, and Daryl, that's big text calling us. Let's see if we can get him on the line.
Yeah, okay.
I'll continue this vein here. So in all, what this really means is we have active listings down 28%, new listings down 2.7%, prices up 9%, pending sales up 10%. So we've got demand is up, inventory is down. So we combine that with some of the other information that we've had earlier on the show, and we got him.
Here's the text.
Hey, Terrell.
Hey, I'm here. Man, this T-Mobile is horrible. I've been sitting here waiting.
You're on the air.
I haven't sent the text message and it's still trying to go through. Sorry about that.
Not a problem. You are on the air right now. Thank you very much. This is Terrell Robinson from WealthWave calling in from Las Vegas, Nevada. I'd asked him to come on the show to give us a little bit of an update as to what's happening. We have about 5 minutes left, and I want to ask you just quickly, what is happening in the market there in Las Vegas, and how are you doing in your business in providing retirement solutions for people in your sphere?
Well, right now the market is steady. Unfortunately, still a lot of jobs have been. A lot of people are still being replaced or laid off in regards to the casinos. So
right.
What that entails is now they're having to make the decision: do I dive into my 401k and pull the money out, or do I hold on and wait for something better to come out in regards to will a position come available? Because again, some of these people have been on their job for 20 years, 30 years, and if they dive into their retirement too early, it can penalize them in regards to taxes, income, and then later on down the road when it comes to retirement. So as for sustainability, though, I'm making sure that I sit down with a lot of parents, number one, with young children, so we can bridge the gap. Get them going right now where it's not an inconvenience and the price is very inexpensive, but also making sure that we can help protect the parents and their future retirement right now as they're proceeding along, making sure that, hey, let's do this annual checkup. I don't care who advisor you're sitting down with, but let's make sure that we got you in a situation to where your funds are protected. So, again, if this pandemic continues to happen, is your principal protected? Will you be taking losses, or are you in a position to maybe grab onto a few of gains as well? So,
okay, listen, we have about a minute, maybe a little bit more than a minute left. Give us your idea as to when you think this pandemic will end, because I'm hearing all kinds of rumors, and let's hear yours. And then what's the quickest way by which people can use your services, and how do they get in touch with you?
Okay, the easiest way to get in contact with me is area code 702-882-2103. And again, that number is area code 702-882-2103.
Okay.
In regards to the pandemic, as you can see now that the Russians, quote unquote, have found a solution, and now it's only through the first phase, of course. But in regards to the pandemic, after this election, and don't want to get political. After election, I truly feel by the time Christmas comes around, this pandemic will have settled itself out. January comes around, we'll start getting back into our normal ways, but being more hyper vigilant in regards to being careful of what we do now that we've solved it. But being careful of what we do, I do see it in the next 3 to 4 months. I see that we have this solution all wrapped up.
You know, your lips to God's ears. I'm all for that. I really hope it happens quickly because there's a lot of people who are hurting out there. Terrell, I really appreciate you coming on short notice. We'll have you back next week for a full interview, if that's okay.
Absolutely. I thank you very much, Jeff.
Thank you very much. That's Terrell Robinson, Big Text from WealthWave. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for each and every week giving us feedback as to what we do so we can bring you better guests, better information, and, listen, you've got problems out there in the real world when you're dealing with either your rent or your mortgage or your job. Anything we can do to help you along with that by providing you better information programs, we want to do that. We're on a number of different podcasts, the Big 8 podcasts. We're at YouTube, Jeff Barton, The Mortgage Voice. We're on a number of different radio stations from Albuquerque to Las Vegas to Inland Empire in Southern California to Lake Tahoe. So if there's something here that you like, click into any one of these things and join the party. Anything you do that helps us advertise to more people is better for us, gets the message out to more people. And again, thank you very much for tuning in. We're going to bring a new person to the show today. I'm very happy that he's allowed us to ask him to come on. And Kurt Lerman he's from Redstone Lending. It's Redstone, isn't it, Kurt?
Yeah, that's correct. Yep, Redstone Funding. Yep, Redstone Wholesale is our wholesale channel. Correct.
Excellent. Okay, well, let's just kick it off. And again, thank you very much for coming on the show. What I wanted to talk about is programs, what your company offers, how you're able to underwrite files, and how you can get money to people who might not necessarily be able to go to big box banks and fit in some cookie cutter square.
Absolutely, Jeff. I'd love to chat with you about our product.
Great.
It's great to be partnered with Malibu Funding. As you know, and the reason for signing up with us is to give you access to some of those non-QM, non-qualifying standard products that are out there in the market. And we can deliver that. We are directly backed by a fund that has been securitizing these non-QM loans for the last 4 or 5 years. They in fact, just during the COVID period, bought off people's warehouse lines several $1 billion, and now we're back at the origination standpoint and being able to help you and your borrowers out there. And for your listeners, what that means is non-qualifying mortgage. It means to qualify them on different things, such as looking at bank statements for a self-employed borrower instead of your standard, W-2, pay stubs, that kind of stuff, tax returns. We can do 12 or 24 month bank statements to look at the income qualification for your self-employed borrowers. We can also, for any of your borrowers that are 1099, maybe 12 or 24 months of 1099 income. Some of your borrowers may be sitting on cash. We can look at asset utilization, where we take the funds that they have divided by 100, and that would be the monthly income that we would qualify the borrower on. And then the list kind of goes on. We can do some help where borrowers may not fit your standard Fannie, Freddie, or FHA, VA lending. If they have some mortgage rates or something like that, we can do up to a 0 times 60, meaning they can have multiple 30s in the last year.
Wow.
And then for any investors that you may have that Malibu is helping finance, investors are a great product for us. We have what we call as a debt service coverage ratio loan, and the DSCR loan you can qualify off rental income. So we're not even using the borrower's income. And we have the ability to look at it whether it cash flows, and that's considered a debt service coverage greater than 1, or we can do it as a no ratio where the property's not cash flowing, and we can even look at that as well. So those are some of the non-QM products that we're able to partner with you guys, and we can go into more depth, and you can ask me any questions you want with respect to those.
You know what? That's a big menu, and people who listen to the show, we used to talk about non-QM weekly because there are many non-QM borrowers out there who are great borrowers who just can't fit into a Fannie, Freddie, or a Ginnie cookie cutter type loan. Now I say cookie cutter, it's not that simple either there, but on a bank statement loan, what exactly do you look for in the bank statements? We throw those around, but what are the specifics? Are you looking for deposits? Are you looking for balance? What are you looking for?
Absolutely. Great question. So with respect to the bank statements, again, it's for self-employed borrowers. And some self-employed borrowers use their personal bank statements for their business, and that's totally okay too. We can do either business or personal bank statements. And then exactly to what you just said, we are looking at the deposits for the last 12 or 24 months. We will back out any transfers or any deposits, let's say from a spouse, that do not come from the business. And we will take those total deposits, and then we will also factor in an expense factor, depending on the type of business. There's a business narrative form that the client can fill out. There's also an ability to utilize a CPA letter to determine what the expense factor would be. Or they can provide a profit and loss during the time, whether it's the last 12 months or 24 months. But that's how we factor the income off the bank statement.
Now, depending on how much of this information you get from each borrower, does that also affect what kind of rate or risk that you guys are taking?
Yes, it definitely falls with credit score. From a credit score standpoint, will help determine the LTV that they can go up to. Obviously, the better credit, the higher LTV score that we will allow. And in addition to kind of your question, is there a pricing difference between a 12-month and a 24-month bank statement? Yes, right. There's a little bit of a bump for only using 12 months.
Now, when we talk to borrowers, the main thing is they're reading and hearing each and every day about how low the rates are going. Now, these are conventional and these are perfect borrowers, yes. And they know about overlays because we talk about that all the time on the show. But given, a typical borrower versus somebody who might come to you for a non-QM loan, can you give us an idea of what the difference in the rates may start at for your particular products, as you mentioned today? That'd be great.
Yeah, absolutely. So with respect to the non-QM lending, obviously, like you said, there's some very low rates out there in the market for standard conventional, just because there's so many accesses and sources, and Fannie and Freddie are taking that product down. This is outside of Fannie and Freddie. It's securitized on a secondary market with private money investing in the bond structure, and they're looking for a little higher yield, right, for the risk. With the risk appetite of using alternative documentation or jumbo loans is one of the things that we can do under the non-QM, or interest only, and then some of the credit profile comes a little bit higher rates with that. So to set the expectations, I think for your listeners and your loan officers over there in Malibu, right now I'm seeing rates starting typically in the low to mid 5s, and then going up as high as in the 6s to high 6s. So that's kind of the range that I'm seeing. Even on investor loans where you're just qualifying off the rental income, that's a completely different risk, because now you're taking the borrower's income out of it. Obviously, there's a down payment and assets and reserves and that kind of stuff. But even those loans are still running in the high 5s and into the 6s. So,
I talk
about cash flow with their properties.
Yeah, thank you. I would talk about rates as if they're I guess, as if they're the king of the loan. A lot of people want a loan, right? And the rate itself is secondary. For instance, people who want to buy something and then perhaps refi it later when they get their finances, what kind of penalty, if anything, do you have? Is there a 3-month prepay, a 6-month? How does it work when somebody wants a shorter term loan and they want to, obviously get a better terms once they get their financing in order?
Yeah, great question. So on any owner-occupied properties, we don't have the prepays on those. So there's no prepay on the owner-occupied. On the non-owner investment properties, the standard par pricing, or where we start, would have a standard 3-year prepay.
Okay.
Now you have the ability, or the borrower, I should say, has the ability to buy up the prepay up to as much as 5 years and get a little bit better rate, or they can completely buy out of the prepay if they feel the need to do so. The prepay is not too egregious. It's typically 6 months interest on 80% of the remaining balance.
I see.
As they pay down the loan, let's say they pay it off in that 3 years, it would just be 6 months interest on 80% of that principal balance that's remaining. So you can pay up to 20% each year without penalty. And then if you paid more than 20%, then you would incur the prepay penalty. And again, that's only on non-owner investment properties.
Hey, Kurt, we're at the end of our time. It's been great. The information is terrific. Could you shout out your phone number for people to get in touch with you if they want to talk to you directly?
Yeah, absolutely. You can always reach out to me, 206-696-1647. And I really appreciate it, Jeff, and appreciate Malibu and all you're doing for the community.
Thank you very much, Kurt. I really appreciate it. That's Kurt Lerman for Redstone Lending, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks very much for tuning in. We are on the Big 8 podcast. We are on YouTube, Jeff Barton, the Mortgage Voice. We have 5 different stations in 3 different states that you can listen to the show. Normally on the weekends, Saturday or Sunday, driving around. If you want to do something, go to Home Depot or wherever else you go, buy flowers at the garden shop for your house. Yeah, that's when we're on, because the information that we have is really housing related. We try to give you information on real estate, but mostly on programs and on ways by which you can go out there and get a loan, whether it's a refinance loan, which there are plenty of them right now, or it's a purchase loan. In any case, that's what the show is. That's what we try to do, and we've been bringing it to you for about 6 years now. So again, thank you very much for listening. And if you go to any of these places, sign in, sign up, ring a bell, do anything you can to get me into your ears in any way possible from many different media sources. Again, I'm Jeff Barton. This is The Mortgage Voice. And joining us from Accelerate Capital is Alma Carrera, who we have talked to before on the show, and she's back again to tell us what kind of programs are being offered and how we might get some more people into loans. Alma, how are you?
Good, great, Jeff. Thank you so much for having me on. I really appreciate it. Thank you.
And thank you, too, for coming on. Okay, tell us about Accelerate and what are some of the programs you guys are offering?
Okay, thank you so much. Accelerate Capital basically has been in the wholesale industry since 2004. We were primarily non-QM lenders, and as you know, what's happened in the industry as of March, we basically took a pivot. Now, we've always been in the conventional FHA agency world, but, non-QM was our primary source. So with the pivot, what we basically did is concentrate more on the products of the FHA conventional. So I'll share that, but we also just came back on the non-QM program, and we are fully delegated. But to start off on our conventional, what's really great about our programs, obviously, it's not only just rates, which everybody talks about, but also the way we're doing business. We are offering quite a unique product base as far as your standard conventional. on our standard conventional that you'll find on our rate sheet, just one of the highlights is not only are we competitive, but for instance, we don't charge for waiving escrow. So that's a big thing for us.
Right.
And then we came up with a premier FHA program. So we have our regular standard FHA program for the regular FICO, if you will. But if you have a higher FICO, we actually have a premium rate sheet where you can get best product there based on rate. So we have both covered. And then we also
let me ask you a question.
Streamline
Alma.
and Earl refinancing for those borrowers out there. And what's great about our Streamline Earl refinance capability to Streamline is that we do a no FICO. So by doing a no FICO, say someone just wants to refinance, and as you know, on an Earl and a Streamline, we don't require appraisals, income verification, any of that, but also gives you a chance just to do a no FICO capability with just basically proof of insurance, your mortgage statement, penalty, and that's basically it in order to get that done. So not only are you getting the best rate possible, but also the least documentation available as well. So that kind of covers my convention. Yes.
Okay, I had a question, if you don't mind. The question is simply, when you talk about the premier pricing for people with better FICO score on an FHA, you're talking about rate. Well, the rates on FHA are pretty spectacular right now. What kind of special rate do you give someone with a higher FICO score?
It's just it's another additional tier for the better pricing. Again, it is FICO based. So
what does that mean, though?
On the LTV scenario of primary residence and such.
Okay, so it's not a break on necessarily the rate. It's just gives you an ability, if you have different ratios, to get the loan. Is that what you're trying to say?
No, and what I'm saying is we have our standard, FHA rate sheet, but then we have an additional premier. What it is rate based, it just gives you an additional tier of reductions based on higher FICO, if you will. But for that premier rate sheet, if you will, the minimum FICO, for instance, is 640. So it is obtainable. So it's not like 700 and above to get the best pricing.
I see. So what you're saying is, without that, you go down to what is your lowest FICO score that you go down to?
On a regular FHA, our regular FICO is available at 600. That is the lowest FICO that we can go to.
I see. And when you let me ask you, what are your, I guess, the most popular loan programs that you're currently doing in this market?
So we're doing a lot of agency stuff, like I said, FHA, agent conventional stuff. And then now with our non-QM now coming back out as of August 1st, we brought back our standard primary residence and investment program. So for instance, for our primary residence, we have like the bank statement program.
Okay.
So we can go to 80% LTV. We are able to do some cash out depending on the LTV to 70%. Bank statements mainly for 24 months or 12 months. And then we also are giving a credit back for purchases on that primary residence program on the non-QM. So we do have an incentive.
Okay, well, what is that incentive? Is it a percentage or is it a dollar figure?
I'm sorry, ask me again?
Is it a dollar figure? I mean, are you giving back $500 or is it a percentage of the loan?
It's actually giving you an incentive based on the purchase. It can give you back up to a purchase an eighth back. So it's
I see.
Credit.
Right. On a $100,000 loan, it's X. On a $500 loan, an eighth is a big deal.
Absolutely. Yes.
Yeah.
And we're also doing a clear to close incentive. So if you can get the loan done and get it closed very fairly quickly, there's also a possibility of getting a quarter incentive as well.
Oh, excellent. Okay, so it's a little different approach than some of the other lenders out there in this particular space, correct?
It is, and it's quite unique. So, for instance,
right.
A loan can sometimes lag on and getting closed.
Yeah.
So in the non-QM world, just so a lot of people understand, a lot of the lenders, we're not allowed to lock a loan until it's fully approved. So that's
Right.
kind of like the standard, right, in the non-QM world. But in
Yes.
addition to, if you wait until it's approved and you're ready to clear to close, and you haven't locked it at that point, we pretty much have all the conditions, everything signed off. So we'll give you that additional pricing of a quarter to get that just clear to close and get it done and get it into docs.
No, that's a very good thing. And your particular rates, where do your FHA rates start?
Okay, so that was the incentives I was describing you. That's on the non-QM,
I see.
not on the FHA.
I apologize for that. Let me ask it again. What do the rates start at on the new non-QM side?
With a 760 FICO, and depending on LTV, it could be as low as 4.875.
I see. Okay.
Pretty
Well,
affordable.
right. And on those bank statement programs, you're looking for deposits to be a certain amount every month. Are there any restrictions on those deposits, or you're looking for any red flags on those deposits?
No, it's just a continuing verification that those are bank deposits that we can use either the personal account or a business account. Now, we aren't able to do both accounts. It's either one or the other.
I see.
We're basically taking the deposits from that account to qualify.
Now, is there a lot of appetite for these type of loans out there in the secondary market?
You will see, definitely there's, the lenders started to come back, but we just recently just came back as of August, and we were waiting to not just come back and offer it again as we were concentrating before, but we wanted to basically come back with what we had before, which is we're fully delegated with our products. So we don't have to delay in closing the deals. We already know what our underwriting guidelines are, and we can, yeah, exactly. So we can get them done quickly and more efficiently for those borrowers who are trying to do purchases in particular.
Alma, can you shout out your phone number for people if they want to get in touch with a great lender and a great account executive?
Oh, thank you so much. My direct number is 310-321-8259.
Okay, very good. Alma, thank you very much for coming on the show once again, illuminating and teaching us a little bit about what's going on over Accelerate Capital. Thank you very much.
Thank you so much, Jeff, and have a great day.
And you too. That's Alma Carrera from Accelerate Capital. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for listening, and thanks very much for tuning in to us each and every week. When you do tune in, we have some, on a couple of the radio stations, they show the video feed of this particular program as well. You can see our guests, you can watch it, KCAA, KMET. And Daryl, do you know if the other stations carry them? I just don't know.
They just carry the audio at this point.
Okay, very good. And that would be, of course, those two were in the Inland Empire. The other three that we're on, and we're on some FM sister channel stations for those particular radio stations as well. But we're on KTHO up in Lake Tahoe.
AM/FM, yeah.
Yeah, AM/FM, that's right. And also up in Las Vegas at KSHIP 1400, and down in New Mexico, in Albuquerque, New Mexico, which is the largest city in New Mexico, by the way. A lot of people who are listening to the show don't know a lot about New Mexico, but it's a very interesting market. And yeah, so what are the call letters down there? KMIN?
Yeah, KMIN. KMIN Country, AM and FM.
Country Western States, yeah, great station down there. Love the people. Love to be able to get some more feedback and information from the local affiliates down there. But we're working on it, and we're constantly trying to get local people in all these markets. I am not in enough markets to really, concentrate just on national issues. We try to get into local issues. We bring guests on from Las Vegas or up in Tahoe, or certainly down in the Inland Empire and Albuquerque as well. We've had a couple of people on from there. So if you're listening and you want to continue to listen to that, that'd be great. We're on YouTube as well. Jeff Barton, the Mortgage Voice. And as again, you can see this as well as many other shows. We're on several of the Big Eight. We're on all of the Big Eight podcasts. If you go there, sign up, sign in. If you like us, ring the bell. Whatever you can do to try to get us to alert you each and every week as to when the show is and when the show is coming and all the issues to them. Okay, let's talk about a couple of things. Discrimination in housing, we've talked about several times on the show, and we're going to just continue a little bit. We talked about the Long Island realtor issue, a situation that had arisen. An investigation from HUD revealed that realtors were in Long Island, I guess, steering customers to certain areas where they thought those customers should live, i.e. it was a discrimination investigation, and it proved out that realtors were at the heart of doing this. Now, I'm a realtor, okay? I'm also a mortgage banker, a mortgage lender. I have a lot of different titles, but as a realtor and as a lender, we are supposed to be able to help anybody, everybody to get into anywhere they want to live. That's just the way it is. It's a bottom line issue for me, and if people don't do it, they're going to have problems with me. Now, how you get there and how you convince people that that kind of behavior is wrong. It's not only wrong morally and ethically, it's just wrong because the country needs to grow together. The only way we can do that is to make access equal to everybody, and that's kind of where I'm coming from on that. There was another, I guess, example of that in Alabama and Mississippi. There were, HUD runs this thing called Section 8 housing. They don't call it that anymore, but what it is it's a low-income housing. It's government subsidization of your rent in order for you to live. And, you know, these are people who are working but are poor and just don't have enough money to live in whatever the rents are in that particular area. Average rents in the U.S. are about, for a one-bedroom, about $600 a month. Let's say you're working, you can only afford $250. The government steps in and makes up the rest. Well, there are complexes, large complexes, all over the country, and I think that particular solution that they came up with a long time ago in the 70s is the wrong solution. I think government subsidized housing is a good thing, but I think we've got to spread this out in every community so that we all help in a situation that, you know, is there. Now, I know people are against that, and we fight that in I guess in a lot of communities. So the idea of housing poor people in large complexes in one area is a way by which you can, you know, push people over into that. Well, anyway, even in those situations where you have government subsidized housing in large complexes, we see discriminatory behavior based on who gets the best unit in government subsidized housing. And in Alabama and Mississippi, this just came out too, probably 5 or 6 days ago. What they found was predominantly white tenants were given the better view units closer to the river in these Alabama and Mississippi housing projects, meaning that people of color, now these are all poor people. This isn't like you're, you know, dividing it up among people that can afford more versus people who can afford. No, this is all people who have the same need for government assisted housing. But they were finding, and it has been proven, you can look it up yourself, Alabama and Mississippi in housing complex along the river, they were giving white folks, I guess, better view, better apartments closer to the river. Now, these examples are typical examples of what discrimination is. We all know what it is, right? We all know when you call up and you make an appointment as a realtor for a particular unit for a particular buyer or a particular renter, we all know in our head we might encounter this. And what we do as realtors and what we do as lenders and what we do as people who are in charge of public housing is to try to erase that from our minds. How do you do that? That's the trick here, because what happens is social norms in given areas lead to, you know, things that are just expected and things that are let go and okay. I don't think it's okay, but those are the things that are happening in terms of what's going on in a lot of the social justice movements in the country. Housing is at its core, as I think housing will lead us out of the COVID issue, out of the pandemic, lead us back in terms of what we're doing as a country economically. We just have to make sure we continually and constantly are on top of housing discrimination and lending discrimination. Banks are sitting on a ton of cash. This is happening all over. This is what happened in 2008. And what I think should be happening is, and it didn't happen, I don't know, Daryl, do you remember that program that was out talking about all the big banks? What was it called? Too Big to Fail? Did you ever see that?
Yeah, it was just amazing. I mean, here, people struggling every day to make the rent and all of this, and then we're propping up megacorps.
Yeah.
Who really didn't need it. Some of them really didn't need it.
Well, that's the thing. They got lent billions of dollars. And what they did is, instead of lending the money out, giving it to people who needed it, right? Coming up with a way by which they could vet or approve certain individuals, they held onto the money and they tightened lending standard. Well, that's what's going on right now too. And we have a much more liquid market than we had then, meaning that there's a lot more money out there. And this whole economic situation has nothing to do with the past loans. So the performance of the past loans, and we talked a little bit about that, the delinquency rate. The interesting thing about the delinquency rate today is that it's at 2.2% of the market. But by comparison, in 2008, the delinquency rate at the height of the mortgage meltdown, or whatever you call it, was 2%. So we're higher than that now, even though this has nothing to do with loans. Simple fact is, people lost their jobs, federal government told them to go home, and now they can't pay their rent. Now they can't pay their mortgage. These are the facts. 1, 2, 3. What are we doing about it? Well, we need to continue to keep the mortgage market liquid. We need to continue to keep people getting mortgages. It's just, how do you keep people, I guess, who are the decision makers, to make decisions for people when their job depends on making the correct decisions, especially in underwriting, especially in risk analysis. It's a very complex problem at that end of the scale, but at the same time, these are the solutions that are needed. There needs to be a way by which we can have either a fund or a way by which these people get longer term loans, or get some sort of forgiveness built into the loan if something in the future happens, whether it's an insurance issue, whether it's an overfunding issue. All these things need to be happening. Anyway, I'm Jeff Barton. Thanks very much for tuning in and listening. I really appreciate it, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.